IBM stock offers passive income investors a dividend yield of 3.88%. Coca-Cola stock offers dividend stock investors a dividend yield of 3.07%. But which one is the better dividend stock to buy now? That's the question I'm going to answer in this video. And I'm going to look beyond just the dividend yield to answer what is the better dividend stock to buy. And you're going to see the factors that I consider when investing in a dividend stock. So let's compare these two.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, like I mentioned, IBM has a better dividend yield than Coca-Cola, but that's only one of the factors that I look at when I'm investing in a dividend stock. One of the other factors I look at is the dividend payout ratio. The dividend payout ratio measures the percentage of earnings per share that's paid out in dividends. It's a measure of how sustainable dividends are. For instance, in this first example here, you have a dividend per share of $1.75 and earnings per share of $2. That means that's a dividend payout ratio of 88%. That's relatively high. That means if earnings per share were to decline below $1.75, that company would be paying more in dividends than it's bringing in earnings. And just like a household that cannot spend more than it brings in earnings for the long term, in the same way, a business cannot pay dividends more than it brings in earnings per share for the long term. Sure, in the short term, it can borrow money to pay the dividend, but eventually it will exhaust its borrowing capacity. Additionally, it can pay dividends out of its savings, but eventually it will run out of savings. That's why in the long term, if you want sustainable dividends, you want a dividend per share that's below earnings per share at a comfortable level, like the second example here, where you had a dividend per share of $2.75 and earnings per share of $10. That's a dividend payout ratio of 27.5%. For passive income investors, what this means is that the dividend is not only sustainable because even a drop in earnings per share of 50% would still mean that the dividend per share is below the earnings per share. But it also suggests that there is room for this company to increase the dividend payment. So investing in this company brings with it the probability that the dividend per share will rise over the next several years. And finally, the last example where we have dividend per share of $3.50 and earnings per share of $1.45, that's a dividend payout ratio of 241%. The dividend payout is more than 2 times the earnings per share. When you see a situation like this, it's likely that this company is going to pause or reduce its dividend payment. That's very likely to happen in the near term unless the company can expand its earnings per share in a relatively short amount of time. So now that you understand why this is so important, let's look at IBM and Coca-Cola on this metric. With IBM, you can see its earnings per share has been on a downward trend from north of $15 per share around 2015 down to $7.53 as of its latest trailing 12-month period. And that has led to a dividend payout ratio that has been flipped for some time, going down below that in 2022 and 2023. But the dividend per share has been steadily rising in that time, although I'm not sure there's much room left for IBM to increase its dividend per share unless it can boost its earnings per share over the next few years. Meanwhile, Coca-Cola's earnings per share has been on an upward trend, even though it took a big dip in 2018. Since that time, it's been rising higher, and Coca-Cola's prospects over the next couple of years are robust, given that Coca-Cola has a strong market share in away-from-home channels like restaurants, theme parks, and things that people have been doing more of since the economic reopening. And you can see Coca-Cola's earnings per share of $2.49 was well above its dividend per share of $1.82, so there's room for Coca-Cola to continue increasing its dividend per share, which it has done already in the last decade. Additionally, I like to look at companies' cash flow from operations to sales, and in this metric, these two have been closely matched over the last decade, with Coca-Cola holding the lead for the better part of the last decade if you were to look closer, and in recent year and a half, Coca-Cola is ahead as well with the 26.38% cash flow from operations to sales metric compared to IBM at 21.96%. Both companies have done well in this metric, although Coca-Cola has done slightly better in this metric. I also wanted to consider revenue growth, and these two companies cannot be considered as growth companies. They don't grow, and if they do, you can expect them to grow below double digits, if anything at all. IBM's revenue has been in decline from close to 100 billion down to 61 billion. A lot of this was due to IBM divesting away from its slower growth businesses, trying to separate that out, and that's why it's lead to this big decline in revenue. This wasn't an organic revenue decline. This was engineered by management trying to separate out some of those businesses. Coca-Cola has done somewhat of a similar strategy. It does a lot of acquisition and divestitures of its brands and some segments that are not performing to its requirements, and that's why it's been on the decline as well. But lately, since the economic reopening gained momentum, like I mentioned earlier, that's been a boost for Coca-Cola as it's seen its revenue jump to 45 billion, and I wouldn't be surprised if over the next 2 years Coca-Cola has continued solid revenue growth. But after those next 2 years, I suspect Coca-Cola will settle down to a long run revenue growth rate between 2 and 4%. 4% would be a really good growth rate for Coca-Cola in the next decade if it can achieve that. Although for the next 2 years, I think it'll be above that 4% rate because of this pent-up demand for away-from-home experiences and Coca-Cola's strong market share in that area. Finally, I wanted to compare these two on valuation, and I chose to use the forward price to earnings ratio. Let's see why that's important. The price to earnings ratio is an important financial metric I use to determine which stock is more expensive or if a stock is too expensive. Let me show you this example here. I have two stocks, one trading at a market price of $100 and one trading at a market price of $12. The one trading at a market price of $100 has an earnings per share of $2.58, while the other has an earnings per share of just 11 cents. When we look at their price to earnings ratio, the one trading at a market price of 100 is trading at a price to earnings of 38.76, while the one trading at a market price of $12 is trading at a price to earnings of 114. So in this example, the one trading at a market price of 12 is actually more expensive because I'm paying 114 times earnings to purchase this stock. That means if the company was to pay me earnings per share every year as a dividend, it would take 114 years for me to receive my money back. Whereas the other stock, it would pay me back in 38.76 years. Now, there's a lot more to think about in this equation, but to simplify, that's an example that shows you why a company with a market price higher can actually be cheaper than a company with a market price that's lower. Okay, so now that you've got an idea of the importance of the price to earnings ratio, you can see Coca-Cola is selling at a 19.98 forward PE compared to IBM trading at a forward PE of 15.87. However, given all of the things that we've considered, if I had to pick one of these two dividend stocks to buy today, I would buy Coca-Cola. I would buy Coca-Cola stock as the better dividend stock to buy, which you might find surprising considering that it has a lower dividend yield. But the other factors outweighed the dividend yield for me, and that's why I would choose Coca-Cola in favor of IBM. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.